My name is Jake. Welcome to the channel. In today's video, I want to talk about investing in the stock market and investing into individual sectors and how each individual sector has performed historically, as well as share some of my thoughts on how each individual sector is going to perform in 2020. Because I think that's important. It's important to look at what has happened in the past, as well as where we're at currently and what are the future opportunities down the road in each individual sector, as well as share with you, those of you that are following the channel. Typically those that follow and watch my channel are newer or beginner investors. And that's really who I focus on in my channel. I share here on YouTube very candidly what I'm invested in. I share my whole portfolio. This is M1 Finance, what you can see on your screen. I transferred over my portfolio from Robinhood into M1 Finance the middle of last year, and I've been dollar cost averaging into the portfolio for a little over a half a year, almost a year now. Like many of you, if you're investing in the stock market, my portfolio has also seen a pullback like the greater market. But I'm invested into blue chip companies that are well established, that most of you out there have heard, whether it be investing into Apple, Microsoft, Kellogg's. Many of those companies that are more established, have a competitive advantage, and have a track record of dividend growth. That's really what I'm focused on. So in today's video, I want to take a look at the different sectors that have performed differently over the last couple of weeks, months, year to date, as well as going all the way back to 2007. So let's take a look at how the market has performed over the last month. Over the last month, each sector has performed differently. And something that really catches my eye is on the lower level and the higher level. So healthcare has been performing much better over the last 30 days than sectors like basic materials, industrial goods, financials, and other such industries. I think this is actually going to continue. The market is pricing in what's going to happen, or what the market believes is going to happen over the next coming months. Now, this is why you're seeing so much fluctuation in price, because investors, not only individual retail investors, but institutions, are not being able to rely on fundamentals. The revenue of the companies, the price to earnings, the fundamentals of investing, because everything is being dominated by fear and anxiety today. A lot of investors, especially institutional investors, are trying to go on invest based off the technicals. Technicals being, okay, where was the last point that that this individual stock or the market or an index dropped, and we're going to set limits around that range. Now, a lot of this is not working, and this is why you're seeing a lot of this volatility, these massive swings in every direction, because the market is being driven by fear. And what you can see is that the market is forecasting, before we even have the numbers, the jobless claims that have not yet fully come out, unemployment, drop in revenue from these industries that we're seeing here, whether it be in retail and whatnot. But the market is already pricing in where it believes it's going to be here in the next coming months. So it's not based off of fundamentals. If you were to go and look at the year-to-date performance, something that is really standing out to me is technology and healthcare are really leading the way, and not far behind with consumer goods. I think that this is going to continue, and I want to take a look here in a second on what it's looked like during the 2007, 2008 crisis, during the financial crisis. But something that I want to highlight here is basic materials. I don't think that this is going to change anytime soon. Basic materials have just been annihilated, and I think that this is going to continue here in 2020. When we look back at 2019, if you've been following the market, a lot of economists have been saying, yes, 2020 is going to be the year of the recession. And then as we continued, as the year progressed in 2019, a lot of economists kind of dialed that back and said, okay, well, there's actually going to be a lower chance of recession in 2020. And then, with everything that has gone on in 2020, it kind of hit us like a bulldozer, and, it's escalated pretty quickly.
Boy, that escalated quickly. I mean, that really got out of hand fast.
It jumped up a notch.
It did, didn't it?
All right, so let's take a look at the historical performance over the last couple of years, more especially the last financial crisis in 2008, and what sectors performed the best and the worst during that time period. So in 2008, the peak of the financial crisis, there's really no surprise that the financial sector performed the worst. And so if you look in 2008, it performed the worst. The following year, it performed a little bit better, and it's kind of staggered here throughout the last couple of years. The next sector would be the materials sector. It kind of, it jumped rapidly back up in 2019, but it got pretty hammered in 2008. One sector that I think is really interesting, this is a very cyclical sector, is the information technology, your technology sector. In 2008, it got really hammered. And then following that, it just had a massive comeback in 2009. And throughout the bull market, it has performed pretty consistently over the last couple of years. And we'll come back to that here in a second. But some of the best performing sectors in 2008 were consumer staples, your essentials, your Clorox, your food stocks, your Walmarts, your Kellogg's, your General Mills, items that people, whether in good economic times or bad economic times, have to consume. So consumer staples performed the best. In this case, they were still down 15%, but performed the best in 2008. The second best performing sector in 2008 was healthcare. The third was utilities. And I think this is pretty consistent with other economic financial downturns over time. The consumer staples, healthcare, and the utility sector generally perform a little bit better than more cyclical sectors like consumer discretionary sectors, industrials, basic materials, and so forth. But when you look at the recovery in 2009, information technology just came roaring back. Materials also came back. Consumer discretionary, consumers had more money, they were spending more, and you can see that recovery. What does that mean for us here in 2020? If history teaches us anything, that I believe that with this crisis that we're experiencing in 2020 is a little bit unique. We could say over time that yes, this time is different, but I believe that history is going to repeat itself in many ways when it comes to those higher performing sectors that we've seen in the past. I believe that if I were to look into my crystal ball and say, okay, what are going to be the top performing sectors in 2020? I think the top performing sector is going to be consumer staples. I think the second best performing sector is going to be healthcare, utilities, and I believe the fourth best performing sector, now there's kind of a toss-up, but I think that the fourth best is going to be technology. Technology is going to be the fourth best performing sector in 2020. And I think that that's really interesting when you compare it to the last financial crisis. It was one of the worst performing sectors in 2008. Now, the playing field has changed quite a bit here in 2020, but I think that the technology sector is actually going to surprise us. Yes, it's a cyclical sector, but I think that it's going to perform a lot better this crisis than we've had in previous crises. Okay. And the reason why I say a toss-up, I think it's kind of a toss-up between communication, the communication sector here in telecommunication, and technology, because there, in some cases, you could kind of see a little bit of overlap with how you say, okay, is this a technology company or is this actually a communication company? But I believe that the technology sector is going to perform much better in 2020 than it has in previous financial crises or economic market downturns. If I were to look into my crystal ball and say, okay, what are going to be some of the worst performing sectors in 2020? I think some of the worst performing are going to be consumer discretionary. These are going to be your hotels. These are going to be your amusement parks, stuff like that. Other sectors that I think that are going to perform pretty poorly are also, I think history is going to repeat itself in 2020 with basic material companies. I think these companies, this sector is going to underperform the broader market in 2020. If you wanted to just invest into a specific sector, there's an ETF that you can do that. If you wanted to invest in individual companies, into individual sectors, kind of what I do in my portfolio, you can also do that. I want to share with everybody a way that you can do it very seamlessly, very simple. If you're a brand new investor, you really are kind of nervous to go in and pick individual companies, let me share with you how you could invest into a sector ETF and look at kind of, based off of what we've discussed here, kind of make your decision in terms of how you want to allocate your portfolio here in 2020. If you look at sector ETFs through Vanguard, this has been the historical performance year to date for some of these sectors. You can see that the consumer staples sector has performed the best, though it's down for the year, has performed the best in 2020 so far. Not far behind is the technology sector, the healthcare sector, the communication sector. And the list goes on and on, all the way down to the energy sector. If you want to invest in an individual sector and you want to say, okay, well, I want to be a little bit more conservative in 2020, you could increase the target allocation to a specific sector and invest in this way. This is one way that you could do that. And if you're curious to find out, okay, well, yeah, Jake, I want to invest into these ETFs, but I want to be a little bit more hands-on. I want to know a little bit more in what I'm invested in. And what you can do is, if you were to invest into the VOX, the Communication Services ETF from Vanguard, what you can do is you can actually see what you're getting if you were to invest into this ETF. What you can do is you can head on over to ETF.com. You can look up VOX, the Vanguard Communications Services ETF, and you can go down here towards the bottom. You can see all the essential information. For example, the expense ratio. You can see the number of holdings that are in the ETF, in the fund, just over 100 here. And you can see exactly what you're getting if you were to invest into this ETF. You can see that the top 10 holdings are much heavier weighted. Over 67% are in the top 10. If you wanted to say, okay, well, I want to invest into Netflix and I want to invest into AT&T, but I'm a little bit scared to do it individually, this is one way that you could do that. You could say, all right, well, I believe in the long-term growth of Facebook, Alphabet, Verizon, and AT&T, but I don't want to invest in them individually. You could do that and gain more exposure to them through this ETF, because this is a sector-specific ETF. If you were to go with the S&P 500 ETF, you're going to have less exposure, less allocation to these individual companies in this sector. Right? So, and if you want to see all of them, now this is really important for new investors, right? If you invest into an ETF like this, you have to understand that, yes, you're getting high exposure to Facebook, Alphabet, Google, AT&T, Verizon, Netflix. But if you were to go down on this long tail, you're going to have lower exposure to these other companies. Yes, you're going to get exposure to Zillow, but you're not even getting a percentage into Zillow. So you have to understand that, right? When you're investing in the these ETFs, you have to understand what are the top 10 weighted companies that are being held into these ETFs, because that adds to your risk exposure, and you have to understand, okay, what am I invested in, right? And so this is one way that you can do that. And that's personally how I do it. If a company that I'm interested in, and if I'm looking at these ETFs, if there's less than a percentage point, I really factor that in, okay? And having 67% in the top 10 holdings, this is a very targeted sector ETF. And that could be, in some cases, exactly what you're looking for. All right, so I want to go back into the portfolio and kind of walk everybody through my thought process in this whole thing here, investing in 2020 and investing into individual sectors, and what that looks like for my own individual portfolio. Just really quick, before I do, I sent out a community poll here on my channel just a couple of days ago, and was really interested in hearing some of your thoughts, some of the subscribers of the channel, what you would be doing if you were to receive stimulus or a relief package from the federal government here in the United States. And I know that this is not applicable to everyone. I think about 60% of the people that follow the channel are here in the United States. The other remaining percentages are spread out across the globe. But for those of you in the United States, I sent out a poll of, if you were to start receiving $1,200, this is at the time, this is what the media was publishing in terms of what that relief package would look like. If you were to receive that from the federal government during these, this crisis, what would you likely do with the money? And I thought it was really interesting. Now, given the demographic, the people that view my channel are really interested in dividend investing in the stock market. So it really wasn't that surprising to me to see that over half of the people that responded to the poll, a little over 500 people, that you would be using this money to invest into the stock market. What that means to me is that you already have your consumer debt in check. You already have an emergency fund. You already have a safety net in place, and you're at that stage where you can invest into your portfolio. And I thought that was really interesting. Now, obviously, if I were to run this poll with other people that follow different channels, I think this would vary greatly. But it was actually really cool to see that a lot of the viewers that follow my channel were actually at this stage of feeling comfortable with continuing to invest in the stock market despite everything that is going on in the market. In my portfolio, I'm invested into individual companies as well as the ETFs. And I have my portfolio set up in different slices based off of different sectors. And the important thing here is the target allocation. I have kind of a defensive growth approach when it comes to my portfolio. I'm invested in industrials. A big reason why I'm invested so heavily into industrials is because of the track record. When I screen and look for individual companies to invest in, I'm really looking for companies with a strong dividend growth track record. Companies that have increased their dividend for 10, 20, 30, 50 years consecutively without missing it. Now, obviously, these are trying times. Some companies that were dividend aristocrats that were paying an increasing dividend for many years are now cutting their dividend. And I think this is more important than ever that we follow up on our investments, especially if we're investing in individual companies, that we're staying on track and we're following them. But companies like 3M, Union Pacific, Waste Management, Caterpillar, a lot of these companies I'm invested in. And I'm investing into companies like Honeywell and also companies like Boeing. And for those of you that follow Boeing, Boeing has just recently suspended their dividend. And if you follow my channel and you subscribe to my channel, there are very few reasons why I would ever sell a stock. And I am really contemplating when I am going to sell Boeing. I'm not at that point where I'm deciding if I'm going to sell Boeing. I am going to sell Boeing. The question is when. I am investing for dividend growth. And when a company cuts its dividend or suspends its dividend, especially in a case like Boeing, this is not a company that I want to invest into long term. Now, I believe that Boeing will likely have a turnaround. It will likely come around, but for me as a dividend growth investor, someone that is looking for continual consecutive growth, this is not a company that I will hold in my portfolio long term. There's other companies like, if I can find it here, Southwest Airlines. Southwest Airlines, if they were to suspend their dividend, I believe that I would likely hold on to them. Simply because this is something that has happened to them to no fault of their own. I will likely hold on to Southwest Airlines if they were to suspend their dividend. Another company that I would likely hold on to, given the circumstance of what is going on, is holding my Marriott hotel shares. Marriott did nothing. They did nothing to be in the situation that they're in today. I will likely hold on to my Marriott shares. I believe Marriott will have a swift turnaround once everything settles. Once we overcome what's going on here in the market in 2020, I think you're going to see Marriott have that hockey stick effect where they're just going to shoot right back up. And I'm keeping a close eye on Marriott, but for now, even if they were to cut their dividend in the short term, I would hold on to them. Another one is going to be Darden Restaurants, like if with the Olive Garden. No fault to their own. They're really right in the middle of all of this. I'm going to be holding on to the Olive Garden, to Darden Restaurants, even though they've cut their dividend, and I'm going to be holding on to them. Now, if another company, and this is why it's so important to follow up on your portfolio, and I'm going to share in a second of how I do that. Especially when it comes to dividend cuts and dividend hikes. But I'm also invested into consumer staples. I have an 18% target allocation to consumer staples. I've had this allocation for some time now. It's not that I've just changed this or updated this recently. I've had this target allocation for quite some time now. And I have the target allocation broken up where, I have a lower allocation to energy and telecom. But as you know, I don't invest into bonds. Obviously, portfolios that are holding bonds are going to perform better than 100% equity portfolios. 100% equities like I have in my portfolio, right? And if you were to look at my overall holdings, now, this is dramatically changed. If you look back in my previous videos a couple of weeks ago even, my portfolio, you can see it now, and if you were to look back, it would look completely different. And that's okay. And some of you that follow the channel may have remember me saying that I wish that Coca-Cola would go down so that I could buy in at a lower price. The companies that I have in my portfolio, I stand with them, with the exception of a few, right? With Boeing, like I mentioned, I'm going to be cutting Boeing. But the remainder of my portfolio, unless they cut their dividend in some circumstances, for example, with Franklin Resources, with Ben, if they were to cut their dividend, I will be removing them from my portfolio. Other companies like the Travelers Company, Sonico, Stanley Black & Decker, GPC, Leggett & Platt, these companies, if these companies cut their dividend, I will likely cut them from my portfolio. Another company that I'm keeping a close eye on is ABM. They work very closely with office buildings. Now, this is really no fault to their own. Now that office buildings are being shut down, there's no need for maintenance. I'm a little bit more understanding when it comes to this. But other companies like McDonald's, Honeywell, Deere & Company, if these companies cut their dividend, I'm going to really have to see, okay, do I really want to keep them in my portfolio? But other companies like Visa, 3M, I go down here with Caterpillar, Southern Company, MDT, Johnson & Johnson. I'm loading up on Johnson & Johnson, Nike, AbbVie. If these companies go down, I feel so comfortable buying in and averaging into these companies. Pepsi, I've been following Pepsi for a year now and just hoping that it would go down so that I could buy more into Pepsi. Lockheed Martin, this is another one. And I'm going to share a video here in the coming days. I might actually do a midweek video on some of the companies that I'm following more heavily and that I think are great value picks. So look out for that video. I'm thinking about making that here on Wednesday. Typically, if you follow the channel, I usually just come out with a video every single Sunday, but I might be coming out with another video here in the middle of the week, looking at some buying opportunities and going a little bit deeper. Another one that I'm really excited about is AT&T. I bought AT&T at 29, just under 30 bucks. It's now just over $28. So this is another one that I really have on my radar. So a lot of these companies, I feel comfortable going into my portfolio and dollar cost averaging into these companies. As you can see, I am still averaging into the market. I'm actually in some cases adding larger deposits as the market dips. I'm nibbling, I'm putting a little bit more in as I see the market go down. And I'm also still receiving dividends. And these dividends are being reinvested into my portfolio. 2020 is going to be a really big year for dividend cuts. And I think if you invest in individual companies, it's important that you follow up on your investments. One way that I follow up on dividend cuts is through a Twitter account called Dividend Cut. And they're very consistent when it comes to posting when companies cut or suspend their dividend. Pretty resourceful stuff. I've gotten a lot of value out of this account. I'm not affiliated with them. I just think it's really interesting. As you can see here, on March 19th, Darden Restaurant suspends quarterly dividend. This is how I heard that one of my investments suspended their dividend. So some really helpful stuff there. Another account, a Twitter account that I follow here for dividend hikes is called Dividend Hike. And when a company increases their dividend, this is a channel or a Twitter account that will post those, and you can follow that. I hope that this was helpful. If you're new to the channel, I'd invite you to subscribe. I share videos like this every single week. Hit that like button, and I'll catch everybody in the next video.